So this week we're talking about depreciation. Depreciation is important when you're learning about accounting, finance, things like that, because when you have something that you buy, typically it's an asset. So when you buy something from a business's perspective, hopefully it's an asset that has some sort of value attached to it. So maybe if you're opening a pizza shop, you buy an oven or a refrigerator. Well, it's cool that you bought that, but the problem is that because of usage, things break down, or their life cycle of usefulness diminishes due to that deterioration. Or what happens is people colloquially say you build a better mousetrap. And so as time goes on, the value of a certain item becomes less valuable, not because it's breaking down necessarily, but because it's been replaced or substituted with something that's a superior kind of in its performance. So think about like computers or technology that you had throughout your life. You might have had a computer or a tablet or a phone that was functioning fine, but unfortunately it didn't have the specifications to run the programs that you needed to run, so you needed to upgrade. So a lot of times people end up upgrading their phones or their computers, not because it broke, but because of the fact that the demands and the needs and the power that's required for the internet or for games or software, things like that, increase exponentially as time goes on. And so they end up having to substitute. The same thing is true for businesses. The difference is that typically if you buy something for personal usage, you're not really treating it as an asset that you can kind of sell or transfer or anything like that. Maybe your car, maybe your house, but maybe not specific personal property that you own. Whereas a business is going to be interested in retaining that asset. And if they liquidate or they shut down or they are trying to help finance a upgrade, they need to know the realistic value of that asset. Because the thing is that if you spend $5,000 on a piece of equipment, it's not going to be worth $5,000 5 years from now, because you could use it a lot and it can wear down, but it also may not be as efficient as newer technologies. So think about used cars. So used cars, when you buy a car, it depreciates in value, one, because maybe it's worn out and it doesn't have as much life left on it. Maybe the engine has 150,000 miles on it. So there's a risk where it might start breaking down over time, etc. And so people aren't willing and able to pay what you paid for the car because of the fact that it doesn't retain as high of a value. So it's important for us to understand what that terminology behind it is and how businesses kind of incorporate it into their analysis of the value of the assets that they own. So the concepts and the objectives that we'll talk about here. The first one is just talking about what the concept of depreciation is, which I've kind of given a little summary of that. But then we will calculate our first method of a depreciation schedule. So basically by schedule means a table. So whenever you hear the term schedule, it means table. And it's talking about kind of what the value of things are going to be over time as depreciation takes hold. So how much will that asset be worth 2 years from now, 3 years from now, 5 years from now? So we've been talking about assets in terms of like interest in money. Now we're talking about assets in actual physical property or machinery or equipment or capital. The first method that we'll use is the straight line method. So the straight line method basically just evenly distributes the depreciation over time, which is simple. Most businesses use that, but it's not necessarily accurate because usually there's a nonlinear relationship between the usefulness and the depreciation value, but that doesn't stop businesses from using it anyways. The second process will be units of production. So instead of looking at it strictly from time, We can estimate what the actual life cycle in terms of the number of units that it's used to produce with, and expect, okay, so because, okay, maybe a piece of equipment is built to last for 5 years, but if there becomes, like, maybe because of the pandemic, you have a huge surge in your demand, and you're really working those pieces of equipment very, very extremely, in terms of, okay, normally we're producing 20 units a day with this machine. Now we're really a power user and we're producing 10 times as much, 200 units a day. That thing's going to break down faster. And so maybe it's a better option to, instead of looking at it from the perspective of, okay, well, how long is it going to last in terms of time? Maybe it's better to look at it from the perspective of how long we're going to use it in terms of units, because it's one thing to say, okay, well, this car is going to depreciate over time because it's been 2 years, 3 years, 5 years, 10 years since it was its model year, and there's been a bunch of incremental or large improvements in the automotive manufacturing industry, compared to, okay, well, maybe my car is losing value because I put a ton of miles on it. Maybe I put 100,000 miles on it in 3 years. Well, chances are, in terms of the structural aspects of the car, it's probably fine because it's only been 3 years. So it's probably not going to be rusting out or anything like that. But in terms of the engine life is probably going to be diminished versus a car that's the same age but only has 40,000 miles on it. You can't conclude that that's going to be the case, but you can have a pretty strong indication that may be the case, and that's going to affect the depreciation schedule as well. And then the third one is the declining balance method. So the declining balance method is looking at the importance of the residual value in the depreciation schedule, meaning, like, okay, a residual value is basically, once this life cycle is passed, what's its value in terms of scrap metal or liquidation value. So maybe its life cycle is passed in terms of your business, but it doesn't mean that it doesn't work anymore. It just means that you're moving on to a new update of that existing asset, and then you end up selling it at the residual value. And the assumption is that the residual value will never, the actual value of your item will never be below that liquidated residual value. And then we're building or identifying depreciation schedules from that, which are just basically tables saying that after this period of time, this is how much the asset is worth, and after this period of time, this is how much the asset is worth, etc. And then the last method is known as the Modified Accelerated Cost Recovery System, and also known as MACRS. You might also see ACRS. And basically what they are is they've categorized different items and the expected life cycle of that item. So if you are buying a piece of property or land or a building or a piece of equipment, the life cycle of that item is going to vary. And instead of you having to do some nonlinear, sophisticated calculations, there are tables that you can consult that estimate the depreciation schedule of that item based on the category in which it falls. So apartment is hopefully going to last longer than a cell phone. And so we need to adjust the rates of depreciation. Also, they may be nonlinear. So this can allow for us to have nonlinearities versus just saying, okay, well, it's depreciate the same rate every year, which probably isn't true. So that's where we're headed. That's what we're covering. It seems like a lot, but really it's just a couple of, just like every week, it's just kind of a couple of calculations that we're applying to different concepts or circumstances and showing you kind of hopefully all of the ways in which you can rearrange or manipulate things so you can determine what you're looking for, what's missing. So again, just some concepts in terms of terminology of depreciation. So depreciation is just an estimate of the use or deterioration of an asset. So like I said, there's two ways in which you can look at depreciation. One is from the perspective of obsolescence, that it's becoming obsolete because it's not being used anymore because there's quote unquote a better mousetrap. The other way you can look at this is that the asset is actually deteriorating, that it's breaking down, it's broken, needs fixed constantly, and so what is the value in that over time? The next concept is asset cost. So that's just how much it costs you to buy it in the first place. So not only do you want to take into consideration the actual kind of market value, or not market, the market suggested retail price or whatever the invoice price of it is, but also the shipping cost too. So if you have FOB shipping point, then you take possession of the goods when it's in transit. So you might have to add those freight charges in. Accumulated depreciation speaks to the total amount of appreciation that's happened. So like, let's say that you buy something for $4,000 and you expect the life cycle to be 10 years and only 3 years have passed. Well, how much depreciation has occurred between day one and year three? That might be something of interest to you. And so that's what accumulated depreciation is. And then estimated useful life is how many years that the company can actually use the asset reliably. So this can be considered in terms of time, whether it's months, years, decades, whatever, or in terms of number of units used to produce. Because if you're you're going to use something with a high volume or high intensity, it's probably not going to necessarily last as long as if you use it at normal intensity, normal capacity, or light capacity or light intensity. And then residual value is the assumed trade-in value or value of the asset once it's ended its life cycle within your business. So that's an estimated value. It's also known as trade-in value or salvage, because chances are maybe if you're like buying a new sink or a new oven, you sell or trade in the old oven for a new oven to try and help offset the cost of that new item. And that residual value is the lowest that the asset can be considered value within your calculation. So technically, you could be like, okay, well, depreciation is really fast, so maybe it's only be worth $100. But we're just saying that even if you overuse, like in the per unit calculation or something like that, that the salvage value is going to be how much it's worth on your books. Speaking of books, the book value is the unused amount of the asset cost that may be depreciated. So basically, it's however much the gap is between how much it's depreciated and how much you paid for it. So if you have something that you paid $4,000 for and you think it's depreciated by $2,000, well, then your book value would be $2,000, unless your salvage value, your residual value is higher than $2,000, then it would just be whatever that number is, because we always assume that the residual value is how much it's worth at its minimum. So even if you like went through the calculation, it seemed like it was worth less than its minimum based on your calculation, we just kind of cap it at that low value. So that's why in red it says book value cannot be less than residual value. So like if we determine that our residual value is, say, we determine our residual value is, I don't know, $1,000, but through our book value, we say, oh, well, we paid $3,000, but based on our depreciation schedule, it's depreciated by $2,100. Well, even though it says $900, we're going to take the residual value because that's the minimum value, and we expect that we can get that as a return. So again, the causes of depreciation, like I said, there's two major categories: product obsolescence. So think of obsolescence. If you never heard it before, think of obsolete. Something that's obsolete means it's basically been replaced by something that's more efficient, more advanced, and more useful. So some businesses have built-in obsolescence where they anticipate that the thing's going to break down over time. Others are market-based obsolescence where the market has kind of come up with a solution that's more efficient and better. And so that's why something might depreciate. And then physical deterioration is from usage. I don't know why I'm putting in quotes, but usage determines this. So they both cause depreciation, but they cause depreciation for different reasons. One, a product is less useful because of better products, or it's less useful because we've used it to the point where it's going to break down consistently, or it's not going to have many days of productivity left before it finally just kind of peters out. So the most common method and most simple method of depreciation is known as the straight line method. The straight line method is used by about 90% of US companies. So even though it's simple and probably not completely accurate, it's so commonly and ubiquitously used that we can feel comfortable working with it. So your depreciation, the way the straight line method works is it basically divvies up the depreciated value over the number of years or however many periods you're using for your depreciation schedule. So usually depreciation is measured in years, but if you have something that has a very short lifespan in terms of its usefulness, you can change that depreciation schedule to weeks, months, years, days. It depends on what the scale of what your production function and production process is looking like. So for the sake of simplicity, we're going to assume it's an annual depreciation. So what we're going to do is we're going to take the difference between how much it cost us to buy, what we anticipate at the end of its life cycle it's going to be worth, that's your residual value, and then divide that by the length of time we believe it's going to take to get to that residual value level. So if we think it's going to take us 10 years, then the denominator is going to be 10. If we think it's going to take us 3 years, then we have the denominator be 3. And then the difference is just, again, how much we paid for it versus how much we think we can liquidate it for at the end of its useful life cycle. So for example, here we have a company that buys a piece of equipment for $2,500. So that $2,500 is going to be listed for cost. They believe that it has a useful life of 5 years. So at the denominator, we'll have 5. And then the question is, well, how much do they think they're going to scrap it for 5 years from now, from the moment that they buy it? Well, they think it's going to be $500. So we plug in $500 here. And then when we do that, we end up with 2,000 divided by 5, which means that our annual depreciation is going to be $400. So every year when we add in when we have a depreciation schedule, we're going to say that the actual book value of that asset that's on our books is going to be what we paid for it or what it was worth at the beginning of that year minus $400. So year one, we assume, okay, it was worth $2,500 minus $400. At the end of year one, it's going to be worth $2,100. And then after year two, we're going to go $2,100 minus $400. I think it's $1,700, then $1,300, then $900, then $500 at the end of 5 years, which is what our residual value is. So our depreciation expense using the straight line method, why is it called the straight line method? Because if you graphed it and you drew a line, it would be a straight line. It would have a constant slope because every year one by one, you're losing $400 in value until you reach that residual value, and then it won't fall below that. And then you scrap it, salvage it, do whatever you want with it, and try to get that $500 back. If we take that information and we create what's known as a depreciation schedule, this is what it'll look like. You put the number of years in the left-hand column. You create a second column that identifies how much you actually paid for it, which isn't going to change. You paid $2,500 for it in year one, so that's what you put. And then you calculate the depreciation expense, which using the straight line method should be the same for every single year. So in the other methods, it might be varying in that column, but for the straight line method, which is why a lot of businesses use it, it simplifies things by saying, okay, every year it's going down by a consistent amount. And so you don't have to do a bunch of different calculations. You just know it's 400 for every year based on the data that we have. And then the accumulated depreciation is the total amount of depreciation that's accumulated. So since we have a straight line method, that means that we're just going to add the same number every year. So since we've calculated that the depreciation for this asset using the straight line method is going to be $400 a year, then we just keep adding $400 every year for the 5 years, which is why your first row for that column is $400, and then you add 400 for year 2, that's 800, add another 400 for year 3, that's 1200, add another 400 for year 4, that's 1600, and then add another 400 for year 5, and that's 2000. And then finally, in the last column, which is actually the one that's useful for your balance sheet if you become an accountant, is the book value. And the book value is going to be how much you paid minus the depreciation. And so, or whatever the book value for the first year, and then for all subsequent years, it's just the book value at the beginning of the year minus the depreciation calculated for that year. So at year 1, you paid $2,500 for it, depreciation is $400, so the book value is $2,100. After year 2, you start with the book value of $2,100, it depreciates again using the straight line method of $400 again, so then it's $1,700, and then $1,300, then $900, then $500. And that $500 is your residual value, so at that point, that's when it's time to sell it and get rid of it and move on and get a new replacement for it based on your business's choice. So even if you held it for another year, year 6, your expected residual value is still going to be $500 because we don't go below the residual value. So even though if you use the straight line method, you would expect, oh, it'll be only worth 100. We don't do that. We just assume it's whatever the salvage value is. So this is, again, using the straight line method, and it's easy to identify. It's the straight line method because you have a constant change in your depreciation. So if we basically were to graph a relationship between time and book value, well, then it would decrease by $400 every year, and you would connect it, and you would have a consistent, constant sloped line, which is why it's considered the straight line method. So does anybody have any questions about that method of depreciation calculation? Hopefully that one's straightforward. It's just, okay, we're going to hold it for 5 years. We think we can sell it for 500 after 5 years. That's how much we paid for it. So we just take the average essentially and then apply it every year at the same value, even though technically probably what happens is it depreciates quite a bit up front and then it starts to level off as time goes on. That's how most things are with depreciation, but this helps simplify things. And if you're going to hold it for that whole length of time, it doesn't really matter what the rate is. It just matters that you end at the correct point and you get the usage out of it that you want. Our second approach is looking at partial years. So what happens if you buy something in the middle of the year? Do we fully attribute the depreciation of the entire year that we calculated to that year, or do we take a proportion of it because it was only a few months or so? And so what we're going to do is we're actually going to do a proportion. So just ignore that 15th rule thing there for a second. The question is how much depreciation is contributed. So the $400 that we have here, this is the same piece of equipment, same company, same piece of equipment, cost them $2,500. Expect the useful life of it to be 5 years. Assume the residual value is going to be $500. So we assume that the annual depreciation is going to be $400. So that's where that $400 is coming from. It's coming from the problem we just did. So the next step is to say, okay, well, how many months out of the year, if we didn't have this for the entire year, did we have the asset? So if we buy this item of equipment on May 6th, well, then we didn't get to use it in January, February, March, and April, but we get to use it in May, June, July, August, September, October, November, and December. So the depreciation shouldn't be the full year because of the fact that we didn't use it for the full year. We only used it for 2/3 of the year. And so what the partial year method does is for any month in which you owned it, you calculate depreciation. But for months in which you don't, you do not count the depreciation. So in this example, because we bought it in May, then every month between May and December counts. There happens to be 8 months between May and December inclusive. So we take 8 over the 12 total months it could have been and multiply it times that $400 that we estimated from the previous problem. And we calculate that the depreciation for year 1 for Ajax is not $400, but because it was only 8 months out of the full year, it's actually only $266.67. So the depreciation schedule will look slightly different because you did not acquire it immediately at the beginning of the year. So that's where this 8 is coming from. The 8 is coming from the 8 months. So even though this is a partial month, we just treat it as the whole month. If it was like May 31st, you could probably get away with just not counting May, but May 6th is pretty early in May. So it's like, I don't know, most of the month, we still use it. The next method we have is the units of production method. So as I mentioned before, there are 2 approaches that you can have to depreciation. The first approach is that there's a finite timeline in which it will break down. So you can have a crystal ball and say, okay, well, 6 years from now, it won't be worth anything. So we're going to say that the life cycle is 6 years. Well, you can do that if you want to, but time is not the only determinant of depreciation. It's also usage, as I indicated a couple slides ago. And so maybe you're more interested in saying, okay, we think that we can get 500,000 units out of this thing. And so every time we produce a unit, we take a little fraction of that depreciation for every unit that it produces, because we think, okay, like maybe it'll last more than 500,000 units and then we get some gravy out of it. But if we're sticking to our life cycle, we'll probably just get rid of it after 500,000 units because we're afraid the maintenance costs will be too high or it'll break down quickly and mess with our supply chain. So what we can do instead is we can break down and estimate how many units we expect to be able to be produced in the life cycle of this asset, and then do the same thing we did before, where we take the difference between the cost of the piece of equipment and the residual value when we plan to salvage it and get rid of it, and then divide that by the number of units in which we plan to produce in the life cycle of the asset to determine what the actual depreciation cost is for every unit that's produced. And then we can determine what the actual depreciation is based on how many units we've already created. So the first step is to figure out, okay, how much do we pay for it versus how much we plan to sell it for at the end of its life cycle. Then determine what the life cycle is, then determine what the per unit depreciation for that item is, and then multiply by the actual amount of units produced in its current life cycle to determine how much depreciation has occurred and thus how much book value still remains on that asset. So if we're still using the Ajax example, the equipment was $2,500, so that hasn't changed. But instead of considering the residual value as solely a function of time, we are instead focusing on the number of units that we think it could reasonably produce in its useful life. So instead of looking at the time component, we're looking at the unit component. So instead of just saying, okay, in 5 years it's going to depreciate, we're now saying that, or it's going to be at residual value. We're now saying that in 4,000 units, it will be at residual value, because whoever we're trying to sell it to or trade it to won't see it to be very valuable, because we don't think that it'll have too much utility after it's been used to produce 4,000 units. So the next step is to determine, okay, what is the per unit depreciation expense? Okay, so we already know this is 2,500. We know this is 500, same examples before. And now we estimate that 4,000 units could be produced before its life cycle has passed. So if we do that, we do 2,500 minus 500, which is 2,000. Divide that by 4,000, and we end up with a value of 50 cents per unit, meaning that every time you make a unit of whatever you're trying to produce with that piece of equipment, the value of it goes down by 50 cents based on our depreciation schedule. So you can build a depreciation schedule not only based on time, you can also build a depreciation schedule based on usage. Or you can look at it from the perspective of both. You could produce a depreciation schedule based on time and usage, which is more realistic than just picking one or the other. So if you want to make a depreciation schedule as it pertains to usage, we have this table here. So again, we still have the time component of years, because we still kind of think, okay, even though we're looking at it from a unit by unit perspective, we're only looking at it, we still expect it to take us about 5 years to produce those 4,000 units. So again, the cost never changes, so that column is going to be constant. It cost us $2,500 on day one. That's always going to be how much it cost us. The next column says, how many units did the firm produce in each given year? So instead of it being a constant depreciation annually, we can get variance in our depreciation. Maybe you have a low volume year. Maybe you have a high volume year. Maybe you're consistent every year. But you actually don't have to worry about that, because if you've calculated the per unit depreciation, it doesn't matter that you're inconsistent with your usage rates year over year. You can still estimate the consistent depreciation annually and determine the real-time book value. So before, if you had a consistent straight line method of determining depreciation, if you had a low volume year, you still took it off your books at the same rate. But if you have a low volume year or high volume year, you can have a more accurate depiction, if you think that usage is a better indicator for depreciation, of where that asset's value lies at any given moment. So if we take 4,000, we divide it by 5, we would reasonably expect that every year you would produce 800 units, but actually in year 1, you only produce 300 units. So if we were basing it off of a consistent straight line, you would expect, okay, 800 units times 50 cents, that's $400. But in year 1, we only produced 300 units. So if we multiply that times the 50 cents that we determined as the per unit depreciation in the previous slide, it turns out that the depreciation expense for year 1 is only $150. And since we had no depreciation before that, then the accumulated depreciation, which is the total kind of stock of accumulated depreciation in dollars year over year, we're at $150. And then the book value, again, is how much you paid for it minus the depreciation. So the book value is only $2,350. It's $2,500 minus $150. So again, this is from the previous slide, 50 cents per unit produced. The accumulated depreciation is, okay, well, it cost us, we had depreciation was calculated 150, so the total will be 150 for year 1. And then the book value is the difference. So again, in the straight line method, after year 1, your depreciation, or excuse me, your book value would be $2,100. Here, your book value is $2,350. And then in year 2, you produce 400 units. So if you do 400 times 50 cents, you get $200. If you add in the $200 to the previous depreciation in year 1, then you're at $350. And then if you subtract the $200 from the previous year's book value, you end up with $2,150. Again, if we use the straight line method, it would have been another $400, and we would have expected that the book value would be $1,700 after 2 years. But because of light usage in year 1, we still expect that the value of that thing is $2,150, just like if you have a used car. The used car, if you do normal usage of it for 2 years, has a certain value, but it might be more attractive and it might be more expensive to get a car that has low miles on it because they didn't use it as much. And so those are the things that we're trying to bake in to this version. And then, okay, so year 3, you only produce 600 units. So again, 600 times 50 cents, which is the per unit depreciation, is 300. Accumulated 650, subtract 300 again from the previous book value after year 2, and you're still at 1,850, whereas you would have been at around 1,300 with the straight line method. Then in year 4, you got that high volume year. So again, the straight line method would have estimated, again, only another $400 drop. In this case, because you had high volume, it's going to diminish at a faster rate. So 2,000 times 50 cents is $1,000. So instead of having $400 in year 4 for depreciation, you get $1,000 of depreciation. So your accumulated depreciation jumps from $650 to $1,650, where it would have been, I think, $1,200 to $1,600. So now your depreciation is higher than it would have been using the straight line method, but that's more accurate because of the fact that you only have so much left in the life cycle in the gas tank, so to speak, versus if you were consistently producing at the same rate every year. Book value is down to 850. And then after that 5th year, you've maxed out the number of units you can produce. And so that 700 units that you can produce before you end up wholesaling it, salvaging it, costs you $350 in depreciation, then bam, you're at your residual value as you expected. Now, in reality, what could happen is you could produce another 1,000 units, and then the depreciation calculation would be like 500, and then you'd be at like 350. But again, like I said in that slide in red a few slides ago, that you can't go below your residual value. So even though it would say it's worth 350, you're still going to try and get rid of it and still get that $500 out of it from that residual value, because that's how much you expect it to be worth, because that's what, and so that's why you use that number instead of some other calculated number if it happens to be lower than residual value. So any questions so far? So the third method is the declining balance method. And so the declining balance method is similar to the per unit method, but what it does is it's kind of a combination of the per unit method and the straight line method. The difference is it's more like the straight line method, but instead of just saying, okay, there's a constant slope every year, it depreciates at the same rate, you instead say, okay, it's going to depreciate a lot at the beginning, and then it's going to slow down in its rate of depreciation as time goes on, kind of like a car, where the theory is that you drive it off the lot. If it's brand new, it loses like 20% of its value. And then as time goes on, it kind of slowly loses value at a decelerating rate. That's actually not happening right this second because of the used car shortage and the supply chain shortages. New cars actually might be worth more used than they were when you bought them initially a few months ago or a year ago. And so it's depreciating in terms of its usage, but because of market forces, it actually is a higher value, which could happen if you are holding equipment that people need. So again, depreciation is an estimate, and your actual mileage may vary and your outcomes may vary. So again, the declining balance method is basically saying that in the early years of the asset life, you kind of accelerate the rate of depreciation. So the common example is to use double the straight line method in the early years, and then just go back to the straight line method in the later years until you reach your salvage value. So this is the same example that we had before, where we assume that the reasonable life cycle of this piece of equipment is 5 years, costs us $2,500 to produce it. And so now what we want to determine is, what is the depreciation going to be in those early years if we use a different methodology? So this little equation at the bottom is telling you what the annual depreciation expense would be, which is going to be the book value of the equipment at the beginning of the year times the depreciation rate, which hopefully kind of makes sense. You're kind of rearranging what you had before, where you're like, okay, well, book value is the numerator, where it's cost minus residual value divided by years, and then it determines, okay, this is how much it's going to depreciate year over year. But the rate at which it depreciates may be faster if you're using the declining balance method, and so it's not going to give you a consistent answer. So for this example, if we use double the straight line rate for year one, what that's saying is that if we use the methodology before and say, okay, well, it's going to depreciate at $400 a year, which is effectively 20% of its, a little less than 20% of its value. But what we have here is we're saying, okay, year one, expected life cycle is 5 years. So that's 1/5, 0.2. Multiply that times 2, because we're using the double of the straight line rate. So that gives you 0.4, which is 40%. So instead of going down by, say, 20% after year one, you're going to go down by 40% after year one. So if you do 0.4 times that residual value, or excuse me, that difference, which is 2,000, then you're going to expect a depreciation equivalent of $800 in the first year instead of the $400. And then in year two, it might be double again. And then you might go to straight line after that until you get to that residual of $500 in year 5, or at the end of year 5. So here's, using that methodology, how it will look in the schedule. Again, your cost is always the same. You always pay $2,500 for it at the beginning, so that's not going to change. The way things change is the accumulated depreciation rates and the book value, and then the rate at which it depreciates. So if we are using the declining balance method, then what is happening is we decided, okay, we're going to accelerate the rate of depreciation, and then it kind of levels off. And the way it may level off is one of two ways. The first way is that you switch over from a multiplier, like we had in this previous slide, a multiplier where we decided, okay, it's going to depreciate twice as fast early, and it'll depreciate at that consistent rate later on. The second, which is what's being used in this graph, this schedule, is that the second way in which your depreciation levels off is because you've achieved that residual value. So even though you haven't reached the end of the life cycle of that item, you can still keep using it until at the end of year 5. The value of it when you sell it is going to be the $500, whether you sell it at the end of year 5 or you sell it at the end of year 3, because the depreciation has occurred so fast that there isn't any more money that's going to be value that's going to be lost from it over time. So it really just depends on how it's implemented. So in one way, it could be, okay, you start with a faster rate and then slow it down, or it could be you just keep with that fast rate, and then once it hits that residual value that you've estimated, you just keep it on your books and say that the asset is valued that much, but you still keep using it until it breaks down. So in this example, we're using the double straight line method. So our straight line method said, okay, it's worth $2,500, or you paid $2,500, it's worth $500 at the end of its life cycle. That's residual value divided by the number of years. So you end up getting $400. 400 divided by 2,000 is 20%. If you decide to do the double, the straight line, then it becomes 40%. So what we're going to do is we're going to take 40% of the cost value, and that will be the annual depreciation rate for year 1. And then after that, what you're going to do is you're going to take the book value at the beginning of the year and multiply it times that depreciation rate. So in this case, since the book value at the beginning of year 1 was $2,500, and our rate of depreciation is 40% annually, we multiply 0.4 times 2,500, because again, 40% as a decimal is 0.4. Multiply that, you get $1,000 is your depreciation for year 1. Again, straight line method, $400. Usage method, depends. I think it was only 300 units that we produced, so it was only $150. The declining balance method accelerates it and says it's $1,000 depreciated right away. So what you do is, okay, the accumulated depreciation goes from 0 to 1,000, and then your book value plummets from the initial value of 2,500 minus 1,000, which is $1,500. Which means the book value at the beginning of year 2 is only $1,500. But if you're still using this accelerated method, it's going to depreciate by 40% again, 40% from the initial book value. So if you do 0.4 again times the initial book value, which is $1,500 now, you end up with a depreciated value of $600. I think that's right. It is, yes, $600. So then your accumulated depreciation is the 1,000 plus the 600. So, and then to calculate your book value, take the book value from the beginning of the year minus the depreciated value, which is $1,500 minus $600, and you get $900. So then your book value for year 3 is $900, and then you take 40% off of that because you're still using that double rate. And the depreciation of that is $360. So then your accumulated depreciation is $1,960. Take 900 minus 360, that becomes 540. So your book value at the beginning of year 4 is 540. So then the question is, okay, well, if we do the 40% rate again, 40% of 540 is $216. So if we did 540 minus 216, we would get a book value of $324. But as I mentioned before, you can't have a book value that is below your residual value. So what we do is we just take the difference between what the book value is at the beginning of the year and the residual value, subtract that, estimate that to be the depreciated value. So it's not 216, it's only 40. And we go 540 minus 40, which is $500. Our total accumulated is the 2,000 we anticipated. We're at 500. And in year 5, we're still utilizing this product because it still has a life cycle and usefulness in its life cycle left. But we've already factored in all the depreciation that we expect. So no more additional depreciation is added for year 5 because we're already at that residual value. And so after year 5, we'll sell it for $500. So this is the declining balance method of depreciation, where you take it at a rate faster than the straight line method. So it depreciates on your books very quickly. And then towards the end of the cycle, when it's already reached its residual value, it's on your books as an asset at the residual value. It doesn't lose any value beyond that, but you're actually getting usefulness out of it because you're still producing items or output with it. So that is the declining balance method. So the straight line one, constant depreciation, divvied up over the years equally. The per unit depreciation takes the estimated life cycle in terms of units, divvies that up based on the difference between the cost and the residual value, and then calculates depreciation based on how many units have actually been produced until you get to the residual value. And then this one basically accelerates depreciation up front, and then towards the end, it levels off or becomes 0 once you reach that residual value. So again, you can see it in a number of different ways. Straight line is still way more common than the rest of these, but you can kind of see how they may be beneficial or not based on how quickly the depreciation takes hold. So another approach, again, this is what I talked about in the roadmap, is that this modified accelerated cost recovery system, what it does is it allows for us to estimate the rate of depreciation for services or goods or items, well, it wouldn't be services, but goods and capital equipment based on its category. And the reason why is because tax laws require depreciation to be taken into account in a certain way, so we don't have money laundering or manipulation of the tax code too much. So the IRS and federal tax law has had to reflect that relationship between estimated depreciation, because presumably if you were an accountant, you could use whichever one is most successful for you. You could use the per unit one and say it depreciated really fast. You could use the ordinary method, not the ordinary method, the straight line method. You could use the declining balance method. And it's probably in the best interest of the business to use the declining balance method and say, okay, well, it depreciated 99% in year 1, so we don't have to pay taxes on it. And so the IRS is like, well, you can't. Well, That's not fair, because then you can just cook your books, and then minimize your tax liability, because you can write things off as a loss because of all the depreciated assets. You can be like, well, we spent this much, we got this revenue, but all this stuff depreciated, so we technically lost money. And so the IRS is like, not so fast, my friend. We're going to build a consistent table system with categorized items, expect and calculate their expected life cycle. So apartments have different life cycles than ovens versus other equipment and facilities. And we have our own table that has that kind of upfront quick depreciation and then that leveling off as time goes on. So they're kind of taking into approach the declining balance method, but at a more consistent rate. And instead of you having to calculate it, they calculate it for you. And that's how you can estimate depreciation for tax purposes using this system. So again, here's the key points. One of them is that it ignores residual value. So presumably you could have a depreciation, something depreciate to zero in its value. It's calculating it for tax purposes as the reason why I just mentioned to you. And then depreciation in the first year is based on the assumption that the asset was purchased halfway through the year. So remember how I had that slide where you had you bought it partway through the year. So even if you bought it on January 1st, for personal property, it's assumed that you bought it on like July 1st, that it was in the middle of the year. So basically they're going to require half of or it's only going to be half of the depreciation for first year instead of the whole year. So like in the straight line method, it would be assumed for the whole year. So we can do the partial year. So if you buy it in January, they're still going to assume it's midway through the year. So you end up only paying for 6 months or having 6 months worth of depreciation factored in. And then there's new laws that add mid-quarter conventions and things like that, but we're not going to really focus our attention on that. And then there's a bunch of different classes. So the classes are based on the number of years. It's assumed that it will take for that life cycle to be exhausted. So class 3, 3 years, class 10, 10 years, class 15, 15 years, class 27 and a half, 27 years, etc. And so different classes of different items have different approaches. So your shorter termed classes have the declining balance method at the beginning, and then they switch to straight line. You have longer classes where they have a declining balance method where it's fast at the beginning and slows down at a less extreme rate. And then the long-term ones, because of the fact that they last a significant amount of time, they use straight line depreciation. Part of the reason for that is if it's going to last for 31 years, you don't want them basically saying they have purchased something for $1 million and then they write it off as a 99% depreciation in year one and say, okay, well, it's really only worth $5,000 or $50,000 when in reality they're generating significant revenue from it. So this is a way to kind of make people honest in terms of their tax liabilities, in terms of how we factor in depreciation, because it's an asset, so it has value. So again, here's all of these tables, cycles. So here's examples of what the assets may be. So yes, racehorses are considered a 3-year. Automobiles and taxis are considered 5-year. Railroad tracks and furniture are considered 7-year. Municipal wastewater treatment plants, 15 years. Sewers, 20 years. Residential rental property, 27.5 years. And non-residential real property, 31.5 years on the depreciation schedule. So again, the 27.5 and the 31.5, they use straight line. 10, 15, or excuse me, 15, 20 uses the 150% declining balance. And then the other ones, 3, 5, 7, and 10 use the 200% declining balance method before they switch to the straight line method after a certain period of time. So again, the federal government has determined, okay, this is how many years this is reasonably going to live or last in terms of its usage. Not it's like actual life, like in horses, it's just how long it's going to be used as a racehorse. And then they use declining balance methods to say, okay, it's going to depreciate at an accelerated rate at the beginning, and then it's going to level off, and we're just going to treat it equal depreciation year over year. So that way, people aren't taking advantage of it. And then, so here's a example of the depreciation in terms of percentages. So if you're using the 3-year class, then it's assuming that in year 1, it's only worth 33%, then 45%, 15, 7. So basically, this is just an example of showing you kind of like what the depreciated values and rates are and how they vary from class to class. So for the 16-year one, notice how like the value of it levels off after year 8. For this 15-year class, it levels off after 7. And then this short one, the residual value is going to be at the end because there's only so many years, et cetera, et cetera. So you end up with these rates that look like this. So let's do an example with the estimated rate. So again, it's a 5-year class. That's what we assume the life cycle of this item is. So we're going to use the 5% methodology, which is going to be this column right here. This second column right here is going to be the methodology that we're going to use and the table we're going to use. But you could also remember it would be 200%, meaning the double of the straight line for declining balance. So you would say, okay, the declining balance, if you're doing it over 5 years, would be 20% per year. So we're going to double that to 40% year 1, then year 2, and then it'll level off and go back towards what it needs to be for years 3, 4, and 5. So again, we have to use that column because of it being 5 years. And then we have, it costs us $2,500. And so we use table 17.5. Again, the difference here is there is no residual value here. So that $500 that we said it would level off at and it would always be worth that much on the books, that's not true for the tax purposes. So presumably this could go down to 0. So that's another big difference. So really there's no straight line determination because it's not like we don't know what the residual value is going to be. So it could be 0, it could be 500, it could be 1,000. So so using this example, this is what our depreciation schedule would look like. Again, 2,500 was the cost. That didn't change. The number of years, again, consistent. But if we use that table, we can see that in year 1, the depreciated rate is 20%, then 32%, then 19.2%, then 11.52%, then 11.52%, then 5.76%. So that means that we would depreciate that $2,500 by 20% in year 1. So we do 20% times 2,500, which is $500. It's 1/5 of 500 or 2,500. So we get 500. So your accumulated depreciation is that, and your book value would be 2,000. Then you would take that 32% and multiply that times the initial value. So again, for the MACRS, the Modified Accelerated Cost Recovery System, it's always based off of the cost, not based off of the book value at the previous year, which is why you're getting these wonky numbers. It's because the wonky numbers are taking it based off of the cost value, not based off of the book value at a given year. Because what they want to do is they want it to be consistent. They don't want you to be like, oh, well, the book value secretly became $1,000. They were like, well, no, it didn't, because you said you paid $2,500 for this. So we know that the book value is going to be this much after this year. So in order you to keep you from kind of manipulating things and taking advantage of it, we are going to have a consistent measurement. So after year two, in year two, they take off 32% off that 2,500. That means the depreciation is 800. So again, your book value was 2,000. So you take 2,000 minus 800, and you get 1,200. Year three, 19.2%. Year four, 11.52, 11.52. Year 6.0576. But anyways, so if we do 19.2%, that means the depreciated value is 480. So if we do 1,200 minus 480, we get 720. If we do 11.52% times 2,500, we get 288. So we do 720 minus 288, we get 432. Again, minus 288, we get 144. And then the last year, year six, basically is saying, okay, well, if their life cycle is 5 years and you hold it for a year beyond 5, well, then we assume the residual value is going to be nothing because it's not useful anymore. Because if it really is going to expire in 5 years in terms of its usefulness, well, if you hold it for 6 years, then it's definitely not going to have any value. So the remaining 5.76% relative to the cost is taken into account for depreciation in year 6. So then you have 144 minus 144, and your residual, or your book value, which essentially is your residual value at that point, is 0. So again, the depreciation is done at a declining balance method rate, but instead of it being based on the given book value in the beginning of the year, it's based off of the initial cost and divvied up. So that way, after the year after which its life cycle has passed, it will go down to having a book value of 0. And so that's how this, for tax purposes, modified accelerated schedule works. So instead of you having to be like, okay, well, it's 40% of this and 40% of that, they've already done the math for you, and you just multiply times the initial cost, and then you can calculate the book value at the end of the year in this way. So let's do a couple of problems, and then we'll be good to go. So in this example, Shearer Foods, which employs 300, not really relevant. The relevant stuff is that they purchase a packaging unit for $185,000, has a life expectancy of 695,000 units, and a residual value of 46,000. What is the depreciation expense for year 1 if 75,000 units were produced? So the first step is we need to calculate what is the per unit depreciation expense. So that methodology, again, you're going to take the cost, subtract the residual value, because again, we still use residual value when we're not using the MACRS system, divided by the life in units. So we get we get $185,000 is how much they paid for it. Residual value of it would be 46,000. Divide that by the number of units, so 695. So if we take the difference between here and here, that's $139,000. Divide that by 695,000 units, and the estimated per unit depreciation is 20 cents per unit produced. So if we produce 75,000 units in year 1, Well, then we take 75,000, multiply that times the 20,000, or excuse me, the 20 cents, and we calculate $15,000 as the depreciated expense. If we want to calculate the book value after year one, then we will take the 163,000, this would be 185,000, subtracts 15,000 from that, and then the estimated book value after year one is $170,000. That wasn't part of the question, but I just figured that it kind of helps indicate the concept. The next problem is that Lena bought a Toyota Tundra on January 1st for $30K. So again, that means that your cost is $30,000. Estimated life is 5 years. Residual value is 5,000. So we can calculate the annual depreciated value. It's going to be 30,000 minus 5,000 divided by 5. So you get 25,000 over 5. And so you end up with 5,000 as your annual depreciation, which is what we get here. This is now asking us what the book value will be after year 4. Well, if we're depreciating it $5,000 per year and it's consistent, again, we're not doing per unit method. We're not doing per unit method. We're not using the accelerated declining balance method. So we just have to multiply that 5,000, excuse me. We just have to multiply that 5,000 times 4. That gives us 20,000 as the total accumulated depreciation. So we do 30,000 minus 20,000. And so the book value is 10,000 after year 4. And then to calculate how much the depreciation would be in the first year, if they bought it in April, we can do a partial year process there. Again, we don't credit months in which you didn't use the item. So we would say, okay, well, we don't use January, we don't use February, we don't use March, but we use 4 through 12. Well, 12 minus these 3 is 9. So we would take that $5,000 that we estimate here, that we estimate annually using the straight line method, multiply it times 9 over 12, which is 3/4. So 3/4 times 5,000 gives us 3,750. So technically the depreciation year 1 is $3,750. So that would technically modify the answer to A a little bit. But if we're ignoring the buying it in April aspect for part A, then it's just easy. You just multiply times the number of years which have passed times the same consistent straight line estimate of depreciation, subtract that from the cost, and then your book value is whatever's left over. So if it's been 4 years, you're estimating $5,000 in depreciation every year, then that means that your total depreciation for 4 years is 20,000. Your cost is 30,000, so your book value is 10,000 for that problem. Just a couple more. So we got 2 more problems, and then we're good to go. Unless you have any questions, happy to answer those. So our next problem, I think there's no reason for that. I think I jumped ahead a slide and still was using the pen. So a company bought a machine for $36,000, so your cost is $36,000. Estimated life cycle is 5 years. And then the residual value is 6,000. So we now can do our 36,000 minus 6,000 over 5 gives us 30,000 over 5, which means our annual depreciation is $6,000, which is what we get here. So our annual depreciation, if we were using the straight line method, is $6,000. So part A, we've just answered. Annual depreciation, if we're using the straight line method, is just the difference between the residual value and the cost divided by the number of years in which you expect the life cycle to be. And then the next question is, what is the book value going to be at the end of year 3? Because we're using straight line depreciation. All we got to do is multiply 3 times that annual, which gives us 18 grand. So 18 grand is the accumulated depreciation, which is what we calculated here. Take the cost, subtract the accumulated depreciation, and then the book value happens to be 18,000. So you had 36,000 as your cost, accumulated depreciation was 18,000, your book value is 18,000. So again, straight line depreciation, hopefully, that most companies use it. Hopefully it's pretty straightforward. It's just the tricky part if you're actually running the businesses, knowing what the residual value is going to be at the end. And then you can put it on your books as follows. The last problem is asking if corporate headquarters for UPS in Atlanta is considering adding to its 96,000 plus fleet of delivery vans. What is year 5's depreciation expense using the MACRS method if one van costs $78,500? So we know the cost is $78,500. There's no residual value. So when you're using MACRS, there is no residual value. So we don't have to do that subtraction like we do with the other methods. So all we need is that 78,500, because remember, we don't keep accumulating like we did with the declining balance method. We just compare whatever the table tells us after a given year to multiply that times the original cost. So when we did the declining balance method originally, it was like, okay, well, this is 25,000, 40% every year. So 40% of 25,000, then 40% of whatever remained after that, then 40% of whatever remained after that until you get down to the residual value. We don't have to do that for MACRS because 1, there's no residual value, and 2, there's a specific ratio that's contributed for each year. So that way, when you add 1 year to the life cycle, the remaining residual value goes from whatever it is at the end of the life cycle year down to 0 in that year subsequent. So this one's actually this one is a little tricky about what it's asking. It's not asking what the book value of it is going to be after 4 years. It's not asking you what the total accumulated depreciation is going to be after 4 years, 5 years, or 3 years. All it is asking is saying, how much in dollars does this van depreciate specifically in year 5? So year 1 doesn't matter, year 2 doesn't matter, year 3 doesn't matter, year 4 doesn't matter, year 6 doesn't matter. The only thing that it's asking for is what is the depreciation expense that's going to be contributed in year 5. And again, since we don't have to calculate what the book value of it is in year 5 is, because the table has already accounted for that. So all we got to do is find year 5 in our table, since we're using the 5-year class because it has a life cycle of 5 years, and we get 11.52%. We convert that to a decimal. We get 0.1152. We multiply that times the initial cost, because we always multiply times the initial cost when we're using MACRS. And we end up getting 78,500 times 0.1152, and we get $9,043. That is how much the depreciation for year 5 will be subtracted. So this is the amount that will be subtracted from the book value. So at the beginning of year 5, there'll be some book value for the van. And we're going to subtract $9,043 from whatever that book value may be at the beginning of year 5. I don't know what it is. We technically could calculate if we went step by step, but that's not what the question is asking. But for the sake of completeness, let's figure it out, and then we will be done. So after year 1, so if we do year 1, it's going to be 78,500 times 0.2. So if we do 78,500 times 0.2, we get 15,700. Year 2, we do 78,500 times 0.32. So if we do 78,500 times 0.32, we get 25,120. That 15,200. Oh, 15,700. That's what I thought. I thought that was a 7, but I wanted to make sure I was correct, since my handwriting wasn't so good. Year 3, we do 0.1920 times that 78,500, and we get 15,072. So again, 78,500 times 0.192. And then for year 4, it's the same as year 5 because it was 11.52%. So we're going to do 9,043.20. We add up all of these numbers together, and that will give us the total depreciated value from the initial 78,500 over the 5 years. So we do 15,700 plus 25,120 plus 15,072 plus 9,043.2 plus 9,043.2. The total depreciated value, so the accumulated depreciation is going to be equal to $73,978.40. If we subtract that from the initial cost of 78,500, then that means that the book value of this van after 5 years is $4,521.60. So that means if they were to sell off or trade in or salvage this van after 5 years, they would get $4,521 from this $78,500 van. And then if you go to the last row in the table, which isn't listed here in this image, it would be, I think, the 5.9%, 5.76%. And so that I would assume that 5.76% of 78,500 is 45,2160, and then it would go to 0 after year 6. So that is depreciation.